Welcome to this webinar on best investment and liquidity strategies in a changing market. I am Marielle Barkley, the editor of this award-winning Global Treasury Leaders Program, which is organized by the Economist Impact and supported by Deutsche Bank. The program has two objectives. On one hand, to share thought leadership, and secondly, to connect treasurers around the world. And we do this through a series of activities every year, which include summits in different regions, webinars like this one you are joining today, articles, and an online community where we host these contents. The community is open to corporates only, and this allows treasurers from all over the world to connect and exchange ideas on any topic of their interest. It is totally free. And I am now going to send you a link via the chat facility so that you can join if you would like to. Just remember to choose the Global Treasury Leaders Network when asked what groups you would like to join. Going back to today's webinar, the idea is to make this session as interactive as possible. So please ask as many questions as you would like using the questions tab, not the chat. The questions tab is if you look at the three dots on the right-hand side of your screen, you have a Q&A facility. Type them there. Please send them to us as soon as you think of them, because otherwise you will forget. We will bring them up when appropriate. So without further ado, please let me introduce today's webinar's chair, Renato Pestana, who is a former group treasurer at Vantiva, also group treasurer at ex-group treasurer Essilor, and who has had very senior leadership roles at other companies such as TNT, Intel, and other large organizations. Renato, over to you.
Okay, Marielle, thank you very much. And again, very excited to be moderating this session. What I would suggest is that we have a quick introduction from João and Michael, and then we go from there. João, you want to kick off yourself with the introduction?
Sure, thank you, Renato and Marielle. So I'm João Oliveira, Chief Deposit Officer of IBM. I'm here on the corporate headquarters in Armonk, New York. So I have about 30 plus years of experience on the financial areas, about 28 at IBM. I started at IBM in Brazil and have multiple roles from internal audit, business controls, treasury related until my last change about 2 years ago to the debt capital market where I am today. So I hand over to Michael.
Thank you.
Thanks very much. Very happy to be here as well from my side. Good morning, good afternoon. My name is Michael Metzler. I work for Deutsche Bank based in Frankfurt. I'm running the European team for Deutsche Bank's corporate bank for investment solutions. So we are supporting corporates on any liquidity and investment topic. I started my career in debt capital markets, moved over to coverage, i.e. relationship management, and are now, as mentioned, focusing on the investment side.
Thank you, Michael. Thank you, João. Before we kick off, I would ask Claudia if you were so kind to issue the first poll just to us to sense a little bit how we're going to be handling the webinar on the choice of instruments, right, Claudia? What alternative instruments are you using to manage excess cash beyond deposit? So if you would be so kind, thank you. We have a kind of a 30 seconds just to give us a little bit of idea where we are going with. And I'm going to give you a few seconds for you to vote, and then we pick up the discussion. Claudia, I think we probably could already show the results, even if more people are voting, we probably could see. Okay, that's a very good point. João, I will start with you, right? At IBM, what kind of instruments do you use? And I would also like to take advantage of the poll results And if you could comment if these results are in line what you would expect, or you'd expect some sort of other type of deposits or other distribution on deposits.
Yeah, so first we invest in also about the same kind of instruments that we have here. So a plain vanilla and low risk instruments like the time deposits that we have here as a CDs or money market funds, and basically all these cash equivalent products. And then that's is essentially what we expect to have, because it is well aligned with most of the peers entities that we also share some experience to get as an investment profile.
Okay, and John, just to pick up where you left, in terms of decision make, right? What would make you go to money market funds and not for CDs, or the other way around? Or what is kind of the investment decision process?
Yeah, our decision process is essentially based on a very similar paradigm as we have on the description of this webinar, the yield, risk, and liquidity. However, for us, the risk or safety is the most important one, because as we all know, the risk of this can significantly damage the other ones, the yield and the liquidity that we need. So after that, after we cross this kind of bridge of the risk assessment, we then align the products that we are purchasing with the liquidity and that we need, and doing competitive bids around that, and finally, of course, maximizing our yields.
Okay, that's clear. Michael, picking up on where João left, right? Or João quoted a couple of instruments that IBM is investing. What are other instruments that you would see corporates investing in?
Yeah, thanks. I mean, basically, obviously the deposit base is bread and butter business for the banks, but also for the corporate clients. Used in many cases, particularly by smaller companies, mid companies, and also the larger ones. It's interesting to see that money market funds are listed next, basically after the deposits, which is also our experience as more and more companies in Europe follow the US, and it gets more and more traction. The securities, i.e., bills, etc., is something where, from my perspective, it's much dependent in most cases on the size of the company. So obviously the larger, the more investments you need to do, the more you're also dependent on that in terms of execution. You need certain setups, which is, it might be cumbersome. So that's something where not all clients are looking into, but more and more. The repos, listed with only 16% is something where we see more and more traction, because particularly following the liquidity crunches and SVB situations last year, where the counterparty consideration played a much bigger role than before, has got more and more traction. Often it's a discussion of not only security and having collateral, but also of the ease of doing business, I would say. Because doing a deposit is easy, straightforward. The more you move down, the more challenging it might become within your organization. And using existing solutions from banks or from us in order to make it easier to invest, for example, in repos, certainly allows companies to look at it in more detail and to then choose this route to add it to their toolbox.
Okay, but I like the comment that you made in terms of, I think, credit assessment, right? Even if we go to commercial papers and CDs, I think was the point from João as well, where you start to already touch some credit analysis that you need to do internally, right? And you need to have some sort of staff and a way to do so. I won't be having a lot of, we won't have a lot of polls on this on this discussion, but I definitely would like to give us a little bit of sense where the other corporates are. I would like to ask Claudia Claudia, if you could bring a second poll, which is what is mainly driving the tenor of your liquidity investments. I think that probably would enrich our discussions as well. Thank you, Claudia. And you're just going to give a few seconds before we move it on. Yeah, Claudia, I think we probably could show the results. And again, if people keep voting, we probably would see, just for us to have a little bit of a sense where other corporates are. Okay, I don't know about Michael and João, but I would be, I myself, I'm surprised on the accounting classification, which is a word that João has used on his answers, also, that you have the investment classified as a cash or cash equivalent. João, any comment on the response that are coming from the poll?
I think all answers are quite closer and connected, and basically the liquidity needs, it's the key item for every corporate, and I would say the accounting classification could be something very linked to that, because as you need, for example, short-term cash, short-term activity, the cash and cash equivalent will echo to have these on the books. So that's what I see, and as a result of the pool.
Fair enough. Michael, on your side?
Yeah, I mean, I guess, I believe it was only, the participants were only able to select one, which might also be, that the accounting is important, but the other one's driving it. We see, very much the 3 months horizon being a main driver for any decision, either this cash and cash equivalent, for sure, irrespective of the product. So, be it on the deposit side or on the repo side, and also on the money market fund side, selecting the ones which get the respective accounting treatment. The first part, the interest rate curve and rate expectation, that's also something which obviously is can be seen right now, diverting potentially Europe and the US a bit, yeah, because in Europe with the inverse curve, people tend to be a bit, shorter partially, whereas in the US, despite being also inverted, but not as much, they might go a bit longer. So that's also, at least one driver. And obviously matching the liquidity needs perfectly right. That's obviously, depending on which pocket you target with your investments, whether it's more on the operational side or rather as a war chest, let's say, for future use.
Yeah, no, I think that's a very good point. João, on your case, I think particularly when we start to go around on credit, right? It's very important that we have the way that we can, one, analyze the credit where we are investing, how we assess, how we limit the credit. We have to have policies around it. Can you share a little bit with us, how do you deal at the IBM, how credit limits are determined?
Yeah, definitely credit is one of the most important, if not the most important, linked to the risk that we just discussed. And so for example, we have significant and strong policies around that, where Treasury do some kind of risk assessment of each counterparty. We partner with the credit department, and also from there we have some kind of limits established to operate. And so these limits are published to the teams and strictly enforced and monitored by the management team.
Okay, no, that's clear. Just to complement here, João, what kind of a controls you have around the credit? So how you ensure, or how the team, or how it's ensured that you are respecting treasuries, respecting the different limits that were established?
Yeah, as these limits are published to the teams, so we have a set of control reports and procedures since before the execution of a transaction, and then control reports that go up to the SOX compliance, etc., to make sure that what was designated or allow us to work with was followed by the entire operation.
Okay, no, that's clear. Michael, I would come from you as we talk to João. He's sitting in the US in a very large US corporate. You are sitting in Europe. What kind of a cultural difference would you see in terms of investments when we are talking about corporate sitting in Europe and corporate sitting in the US?
To be honest, I would not see any major cultural differences. I mean, we have clients, European headquarter, which also have US operations where our US colleagues speak with. Similarly, we have European subsidiaries of US headquarter clients we are dealing with out of Europe. And I would not say that there is a complete different cultural approach to investments. They are using similar products. I would think that the money market fund industry is more developed in the US, obviously, but Europe is quickly picking up. I think on the other instruments, there might be also a small advantage on the US side, but similarly, European clients are picking up. On our side, at least the repo side, or the reverse repo, is something where Europeans are leading in that regard. But there is no general difference. As mentioned before, it could be that from an interest rate curve perspective, the preference for either maturity could be rather seen in Europe or in the US. But it's not a completely different approach, I would say, from my perspective.
Let me get go ahead, João, please. Go ahead.
Quick, if I can add on Michael's answer, I would say it's likely 50-50, but it's not essentially geographies. It's also the kind of the sizing of the corporate that and that can make us leverage different products in a more competitive way from type to type. So that's exactly, it's a kind of combination, but it's more, I would say, sizing than geography.
Okay, that's a very good compliment, João. And just to understand, probably, Michael, on two products, I would get probably one of the most popular one and one that's least used. When you're talking about money market funds, are we primarily seeing dollar funds or euro funds or both?
We are seeing both out of Europe, but to be honest, mainly euro. The euro share is higher. The main currency of the headquarters is usually euros. We have clients who rather use euro money market funds, but then dollar short-term bills or whatever. For example, on the dollar side. But similarly, it's not, I would say, dependent on Europe versus US or any specific parameter, let's say. But on the money market funds, at least the volumes on our side are higher on the euro side.
Okay, Michael, I will come back to you on to complement your answer on the repo. But before that, I would like just to encourage the audience. I see that unless my computer is broken, but I see no questions coming through. So please feel free to put questions forward. That we're gonna make sure that we address, and of course that we mix together with the discussion. So please don't hesitate to put your questions forward. Michael, just going back now, what I would call the least popular one, the repos. I think from the US, this is quite developed, right? And I think that's an instrument that's been there forever. In Europe, do you think that is kind of a picking up in popularity? How do you see it's playing in Europe?
Yes, we definitely see this product picking up. Being the main drivers, for example, the SVB situation last year, where the counterparty considerations is now playing a much larger role, and the management of credit limits on the client side vis-a-vis the banks. So the collateral topic is certainly important. We are also seeing significant demand from banks for repos to finance their bond holdings. The beauty of this product was facing a corporate is that the regulatory liquidity treatment is advantageous on the bank side. So, banks facing banks on the repo side is less advantageous than banks facing corporates. So, in order to make use of this benefit, there is upside basically on corporates entertaining such deals. In the past, or traditionally, the repo has been, quite cumbersome to execute, right? The documentation is quite cumbersome, long, discussions. You need to open, custody accounts to manage the securities, etc. The reporting might be tricky. And if you want to really get the max out of the market, you obviously need various counterparts. You would like to get in touch with, not only one bank, but several banks, yeah. And at least on our side, we have a solution in place where our clients can go via Deutsche Bank and execute reverse repos with various other counterparts in an easy way, where there is no, multiple documentation needed, where they don't have to worry about valuing the collateral, about the margining. They don't have to worry about the reporting, etc. It's, an easy product to manage. And that certainly helps for the broader distribution of it. Because, as mentioned, it's not about only, the collateral and the ease of doing business, but also about the attractiveness of the product. Because, as mentioned, traditionally, it is an instrument traded between banks, so within the institutional market. And when we look at the rates achievable in this market for our corporates, these are very, very attractive compared to other alternatives as well. So there is no real, downside in the repos. Obviously, you need some size and some volume to entertain this market. It's not a market where you can do a small size, but we basically recommend clients to look at it in much more detail than in the past, given all these advantages.
Yeah, that's a very good point. I think not only on DB, but I think there is quite some platforms that have come up in the market, which make life much easier, right? And I would jump for João, but before we jump, since there is a question on repo, I probably would take advantage that we are there. What are the repo's advantage to money market deposits? I don't know, Michael or João, who wants to pick it up?
Should I take a start, and while you can add? I mean, obviously, the security. It has an additional security layer because you do some sort of deposit, but you get collateral in return for it. So it's certainly something which has an additional security layer. And depending on what collateral you are okay to receive, there might also be upside despite being collateralized from an interest rate perspective. Yeah. So the disadvantages, as mentioned, which had been in the past, cumbersome documentation, not easy monitoring and valuation of the collateral, etc., the reporting, that can be taken care of by, for example, the bank. So it's certainly, in my perspective, an instrument where the upside outweighs the downside significantly.
Okay, that's clear. One thing probably, Michael, that I would add on your answer as well, right? So the repos are a basket of securities, right, in different credit ratings. generally over collateralized. And the money market funds, I would say not 100%, right? But most of them, and Michael, let you correct me if I'm wrong, but most of them would be kind of treasury securities, right? So would be, in terms of credit rating, we probably would be a little bit above overall on the repo market, right? Did I say something?
Yeah, I mean, from my perspective, it much depends on the collateral you would basically accept, right? I mean, we on our side have collateral baskets defined which range from government high grade, so basically best of the best, down to anything in fixed income. And depending on where you are on the spectrum, obviously the perceived security, might be different. It is always, fully daily mark to market and fully margined. And you have obviously bank as counterparts. So irrespective of the collateral, there is security, but that obviously has an impact on your perceived security and also on the level. We have clients, playing the full spectrum. So obviously some focusing more on the high grades in order to maximize the security, but others also, while obviously also appreciating the security of a repo, rather trying to maximize the spread of the transactions.
Okay, okay, that's a fair comment. João, coming back to you, we did have a very volatile interest rate environment. If I look back, a year or more, or 2 years, right? We had interest rates going down, or sometimes even negative. We had interest rates going up big time, right? Lately, and now we are seeing the central banks easing the monetary policies and interest rates coming down a little bit still. Question to you, on your way to invest, or your appetite, or in your policies, how this change on the interest rate environment has changed how you were investing, or you were even on a zero interest rate, was for you the same standards that you had at a 5% interest rate?
Yeah, I would say the short answer will be not change it. However, we can elaborate a little bit more, because as we are permanently monitoring all the macroeconomic environment, financial market, industry, peer groups, etc., we have to consider this as part of our decision. However, we take a more programmatic approach on our strategy and guidelines, and it makes us consider the interest rate change as a factor, but not necessarily change our posture because of that. So, and mainly when we have like a worldwide operation as we have, some of these multiple scenarios are already mapped. So we already have the criteria established for scenario A, B, or C, so which essentially give us the enough toolkit to what we need to execute in one of these situations.
Okay, that's clear. And Michael, I would probably ask you to complement a little bit what João said. On your side, and again, you'd have to use the environment of a zero interest rate, which was more, I would say, shocking for Treasury. But did you see corporates that were before very conservative going down on the credit spectrum in order to pick up a little bit more yield?
You mean in the past years during the
zero interest rate environment? Yeah.
Yeah, not too much, to be honest. I mean, usually I would judge corporates as rather defensive in terms of taking active credit spreads. I mean, we have seen that the investment have actually only picked up when rates also increased again on the term side. Obviously, as seen before, the cash and cash equivalent is driving at least some maturity decision. Most activity is in the up to 3 months sector from my perspective. Some are going out to 1 year. I would also share Huao's view that in general, it's tough to take an own view on the rate development, right? Because you're always fighting against the forwards, basically. Yeah. Some have views, more aggressive, less aggressive than what is priced in. Okay. But that has also a limited impact given the short maturities usually traded.
Okay, and I think that's a good point because it goes back. Most of the corporates are conservative at the extreme. So they are not kind of seeking P&L, right? They are protecting the cash of the entity. And necessarily, if you want a more yield, there is something that's quite easy. You need more risk, right? So, and corporates are not, which is in line, I think, what we understand. I would just break 1 second here. I have some questions that probably I would like to come through. Given the absence of bilateral agreement between corporate and the banks acting as a counterparty, what occurs if one bank defaults? How can corporate access and liquidate the collateral without having a legal relationship with the defaulting party? This one, I probably would frame this on the repo markets, right?
Yes.
Yeah, but Michael, you want to pick it up this one?
Yeah, happy to do so. So basically, there are obviously existing GMRAs between us and these counterparty banks. And with one agreement between the corporate client and us, the client basically can make use of these GMRAs and can basically enter into a relationship with these counterparty banks. If such a counterparty would default, then we would basically liquidate the collateral based on the existing GMRA and send the funds back to our clients. So that is the easy answer to that topic.
Okay. And I will take advantage as well. There is one more. As I look to diversify my portfolio, given the challenge market environment, which assets class offer better opportunities? How do I diversify to reduce risk while still pursuing growth?
That's a tricky one, obviously. I mean, we have various risk dimensions which we could look into, being maturity, being credit risk, being optionalities on the rate side, various topics. I mean, diversification to reduce risk while pursuing growth, that's let's say, the holy grail in that regard. But, as mentioned, there are products which, while still focusing on security and being in a collateralized format, there might be upside on the spreads, at least on the rate. But that's tough to comment on, basically.
Exactly. It's a tricky question because we can also diversify counterparties to minimize your risk, as you don't have all risk with a specific group of counterparties. So it's a combination. It's not a simple path that you go, and it's a kind of matrix and a combination between the products and the counterparties that you are using, and finally the sizing of what you are putting in some of these counterparties. Go back to the risk mitigation that we talked at the very beginning. This is a permanent monitoring that you have to keep all eyes on everything going on to make it lower as possible and continue to pursuing growth.
May I ask you, I mean, when we look at the various dimensions, credit risk, counterparty risk, taking bonds, maturity risk, is there a dimension where you see at least a bit more flexibility with your risk department, or is it pretty much handled similarly in all regards?
We have some permanent assessments from the risk perspective. So we think that it's manageable under what is expected by our strategy. So that's how we handle this kind of situation in general.
The only complement that I would add is, which is a very dangerous word that I'm going to use now. So excuse me, and I hope we can stop the recording for me to say the wording, is views, right? In case you would have a views either on currency or in interest rate curves, you probably could say, okay, I will go to a fixed income, a fixed rate or a floating rate. But again, this is views, right? It's not linked to asset diversification, right?
Yeah, it goes to what is your strategy, because if you have more risk appetite based on your policies or the strategy of your company, so maybe it's good to go, maybe it's too risky. So it's all go back to the control side that we have over the treasury operation. So we know exactly how far we can go on these kind of views or something similar, as you mentioned.
Okay, that's a very good insight, João. Thank you. I will probably continue here just to before we move it on. With there is one more question here. Equity markets have been on a rise for a couple of years now. From a long-term perspective, it is clear goal too. However, how would you evaluate the risk of a strong correction for early next year? Wow, this one, if anyone wants to answer, I don't have an answer for it.
Unfortunately, I don't have the crystal ball here with me, so.
Yeah, it goes back to the viewpoint that you mentioned. It's unpredictable.
And just to add, I mean, even in, we all know the political sphere right now, the economic landscape, the central bank views. So there are various moving parts, which, nowadays make it even harder from my perspective to have a clear view for 2025. It will be an interesting year for sure.
Yeah, and I think one thing that I would probably complement, and this is based on my own experience, so it's not a broader one, but I have not seen corporates investing in equities as a part of the portfolio of excess cash, right? I think I have seen investing in diversification by companies, if it's for investment in a safe environment, it's a money market fund, whatever, but not really a portfolio for equities in order to guard or secure its cash, right? Unless you have an equity with an option which you kind of synthesize a fixed income instrument, but then you're not really buying equity, but you're buying a fixed income instrument.
Yeah,
Go ahead,
because
Joe.
some of these can make the liquidity management a little bit challenger. So it's also a component on the scenario that people are evaluating in general.
Okay, no, that's a very good point. We do have another one that I would like to address before we move it on. What average returns for safe government bonds funds, daily liquidity, are you perceiving in the market currently? Euro GBP investments on the 5 million size of investment range. I think probably both of you could address this question, João and Michael.
Yeah, it's also depends of the kind of relationship that you have with your counterparty. Of course, all government bonds or rates are usually the starting point, or to do a kind of analysis if X basis points above or below it's enough for your risk appetite and targets of yield, etc. So this is really case by case, but I would say if you use the government bonds or rates as benchmark, it could be a good starting point for your reference.
Yeah, I mean, obviously, the money market funds is the area to look for probably. On the euro side, various money market funds available. Yes, there's the classical benchmark, but one would have to dig deeper, basically, in terms of requirements, setups, and sizes, etc. So,
but any of you would dare to give a number here? 3% return, less than 3%.
no, I mean, in euros, Esther is at 316 roundabout, yeah, plus minus would be a starting point at least, but that is partially pre-costs. But at least you would have the daily liquidity, etc. But I think you would need to have a closer discussion with the client on what would be the best option here.
Okay. João, would you dare give a number here?
No, the numbers that I mentioned, it's like the TBUs or SOFR, for example, on the US market will be a very reasonable reference, but that's what we.
Okay, while we were having the discussion on equity, I was afraid that this question would come, and it came. So what are your views on Bitcoin? Would you advise corporates to invest now, later, or never?
I would not comment on it, actually. I can only say that from our corporate clients' perspective, this has not been a topic in recent weeks and months. Obviously, anybody is following the public, and it hit 100K this today, I believe, this morning. So it's in the public domain, but we do not see interest from our corporate clients for Bitcoins.
Yeah, I'll make it short. Also, think about risk, and that's all about Bitcoins. I think that what you have to work with when we are talking on potential investments on this area.
Okay, and I will myself twist a little bit the question: would a stable coin change your answers? Because Bitcoin, yes, there is a lot of volatility. It is not secure in value. Would a stable coin change?
I mean, then you would basically discuss a completely different use case, right? Because stable coins would then something be to manage flows and to incorporate in your potential automation on the treasury side, and not a true investment, let's say. Then it's not an investment in this regard. It's more a tool to manage your liquidity. Yeah.
Okay, João, on your view, would that change anything?
Will not change, I would say, my answer, because it goes back to the level of risk that your corporate or your entity it's allowed to take, and that's my view on this kind of scenario.
Okay, I have another question as well, and I leave for both of you. What do you think will happen to the market when Trump takes up his position in January?
Yeah.
I'll comment first, as US based.
This is my personal view. I would say no material changes are expected. Of course, there are some things that will change, new ideas, new administration, and you can judge good or bad based on your personal or corporate perception of that. But it's like I already talked with some other peers, and it's like really a dramatic change. I don't think that will happen, but we never know. It's their mind. We cannot read their mind.
I mean, on our side, obviously the developments have been, for example, incorporated in the interest rate outlooks. So our research foresees that on the ECB side, there might be an impact on the tariffs or on the general political landscape. So they foresee further cuts down to around about 1.5% by end of 25. Whereas in the US, they expect only one cut in 2 weeks' time, and then flat development over the next year. So we see already at least some integration of the outlook from this perspective. into the markets.
Yeah, and to your point, Michael, of course, Trump, the new administration will be part of the geopolitical environment, but this portion it's a little bit more significant and can create more impact than really a specific administration, even with the sizing of the US on this scenario.
João, that's a very good point. João, we had the questions come from the audience, but also on your perspective, right? You are a US-based company. Would you invest in other currencies, and in which circumstance would you invest in non-USD?
Yeah, for the US operations, we essentially have the US activities, but as a worldwide company, we essentially have multiple currencies like the dollar, the major currency, and also the functional currency in several other countries. So that's how is the basket of currency for IBM as a worldwide corporation.
Okay, and Michael, on your side, do you see corporates seeking other than USD, GBP? We just saw GBP, euros. Would you see seeking on investment based in Europe, or only in the local subsidiaries in the local markets, and particularly probably because they cannot pull funds, they cannot take funds off?
I mean, first of all, as you rightly referred to, there might be trap locations where clients cannot get the cash out. So it's about local investments. This is usually done in the home currency. We do business, for example, in Europe in various currencies. So not only euro, dollars, and sterling, but also other currencies. So open to. I would say that I have not seen, corporate clients actively shifting out of one currency into another one just for the sake of investing in this currency. It's mainly driven by, the existing liquidity or potential future liquidity needs. What we see that, us as bank and other banks might be, preferring one currency at a given point in time over another currency. So, be a bit more aggressive in terms of pricing. And then obviously this has, this results in doing more deposits in one currency and potentially less in others. But, other banks might be the way around. So it's, leveling out overall, I would say.
Yeah, I think that goes back to the point, the functional currency, it's the key one across the globe. So that's similar what we see from our side.
Yeah, and João, that's a very good point. Just to come up on that point that you made, would you consider using it for hedging perspective? Arbitrage, again, only traders in banking probably would be doing, borrowing one currency, investing in another. But for hedging purpose, investing the cash in different currencies, would you see it happening? Or João, have you considered it for hedging?
Yeah, we had an active hedging program, but it's not only or related to this investment perspective. But yeah, there are some components, but not exactly linked to that. Not only linked to that. Let's put that there.
Michael, I heard during our discussions you mentioning Silicon Valley Bank a couple of times. Question is, do you see after the event of Silicon Valley Bank, for the ones that do not recall, that a bank that went bankrupt, did you see corporates realizing that, oops, there is something called credit risk. Oops, I need to be careful. Did you saw a change of behavior?
Yes, we did. Obviously, it was a special time, I would say, end of Q1 last year, where before, some clients have managed the counterparty limit in a bit more relaxed fashion, I would say, and then moved and tightened grips on this topic, with some establishing, various treasury policies, be it on external ratings, be it on some internal rating methodology, be it on, CDS levels, general thresholds for banks, etc. So this was very much the topic of 23. In 24, I would say that, it has calmed down for sure, but it's still a topic being in the minds of the clients. So, it hasn't gone away, which is obviously good because, no one knows whether this will come up again. But it's not as high on the agenda as in 23, but it's still driving decisions, particularly obviously for the large clients with large volumes, just ensuring that, it's split over various counterparts and that also this usage of collateralized products is part of the toolbox. And obviously that the access to the liquidity has become more important. The daily availability, for example, or the money market funds tradability, etc.
Yeah, I would add that it make like I stop and thinking point, at least to see, okay, are our policies already covering that? And not specifically for IBM, as I mentioned, we have a significant and robust posture related to this counterparty monitoring, but it's like for most of what was the sizing, what is really the sizing that we are put in place, good enough or reasonable to move in a comfortable scenario. So those what I say that was like, at least let's stop and thinking again. Maybe the answer will be, yeah, we can continue to be good, but maybe there are some fine tuning to do on the policies, etc.
Okay, that's very interesting, João. João, also there is a question that's very closely to what we are discussing. Is there an optimal number? And this is a pure portfolio theory that we're gonna jump in. So hold yourselves on the chair. Is there an optimal number of a counterparties to maintain liquidity in case one fails, like Silicon SVB? I would assume this depends on the size of the company.
Not only the sizing of the company, it's also the risk appetite, the diversification that you want to have in place, because then you can manage your liquidity. Let's say worst case scenario, if one bank fail, the other ones will continue to give you, will be always a loss, but the other banks will continue to give you enough liquidity to move on. So if you are going to put 9% of your portfolio in a single bank, it's too risky. Everybody knows from a treasury perspective how it is. But if you go to put more like among your partners, or will be enough. But there is no specific number depending of the sizing, as the question lists, the sizing of the investments and or the company that you are part.
João, would you comment on how many, counterparties you face roundabout?
No. In general, from a risk perspective, it's
Yeah.
I would say goes back to the key item of this webinar was like risk, yield, and liquidity. Goes back exactly to these three magical words that take care of almost everything that we need to pay attention from an investment perspective.
Yeah. And obviously depends on the product, right? I mean, I guess the background of the question is deposits. Establishing deposit relationships with, I don't know, 25, 30 banks is also quite cumbersome. It's not an easy one.
Yes.
So there is also some administrative part in this topic. If you look at, money market funds, we have clients with large positions who also split it in 3, 4, 5 money market funds. Similar on the repo side, splitting it with 5 to 7 counterparts, for example. But I would say on the deposit side, the large companies tend to have more counterparts,
Yeah.
at least to have flexibility to make use of them, not always spread around it, but at least to have open lines or open business.
Yeah, at the same time that you have to split the risk among multiple counterparties is better quality than quantity, of course. That's how one of the best way to protect the money.
Yeah, and I think also going back to the point that you all mentioned, right? I think it depends on not only the size of the company, but also the size of the cash pot that you're currently managing. And I you just probably highlight, emphasize what Michael and you, João, said in terms of if you're going for instruments like money market funds or repo, you're already getting a diversification there, right? So you're not running what you would call the risk of one counterparty, the balance sheet risk of one counterparty. You're already spreading out your risk everywhere. Gentlemen, we are almost, ladies and gentlemen, for the audience, but gentlemen for the speakers, we are almost running out of time. I would have probably just before sending back to Mariel, I would have just one last question here. In terms of credit, how do I analyze credit? What are instruments? So Michael, you said about CDS. We need to be a little bit short here because we don't have much time. You talked about CDS. What are other handy instruments for us to manage credit? And João.
Are you referring to basically the credit of a counterparty bank, or
yes,
yeah.
Of a counterparty?
I mean, obviously the obvious one is the external rating. Then obviously CDS levels is one feature which clients use. Then obviously banks, publish or have to publish regulatory ratios, which also gives you a sense of, from a regulatory perspective, some clients, prefer to deal with, for example, global systemically important banks because these might be seen as more stable in terms of crisis. I would say that these are the main comparable features.
Perfect. Mario, I think we are probably running out of the time, so I probably would hand to you back the webinar.
Thank you very much, Renato. Thank you for chairing this session, and thank you, Joao and Michael, for sharing your experience and best practice. I would also like to thank Deutsche Bank for making this event possible. And finally, thank you all for being here. I hope you found the session helpful. Please feel free to continue this conversation with the speakers and colleagues at the Global Treasury Leaders community. You can join using the link I shared with you earlier on the chat. I'll ask Claudia to maybe share it again if possible. And through that platform, you can exchange experiences and ask questions to all the members, and we share contents on regular basis. Someone asked whether we were going to share the recording of this webinar. This will depend on if we get authorization. So, but probably yes, stay tuned and we will let you know. On our next webinar will be on the 5th of February, and it will be on in-house banks and how to make them real business growth enablers. So I hope to see you there again. We will be sharing information soon, so please watch out for our emails. And I hope to see you all then. Thank you very much and goodbye.
Thank you. Thank you all.
Thank you.
Bye-bye.
Thank you much.
Bye.
Bye-bye.